Welcome to this week's edition of Invest Africa. I'm Alicia Seckham. Well, in recent years, mergers and acquisition activities have become an important channel for investment in Africa for both global and local market players. This week, we take a closer look at how merger and acquisition deals have enabled companies to consolidate their position on the continent. Let's take a look.
Over the past decade, Africa has been among the world's fastest growing economies in the world, with an average GDP growth rate exceeding 5%. Despite this growth potential, African mergers and acquisitions are no more than 3% of the global merger and acquisition market.
What people need to appreciate is when you're doing deals in different territories with different cultures, different rules, I think you need to approach it in a much more thorough and more patient way than perhaps doing a deal in a much closer proximity with an environment that you understand. So I think one of the areas that people sort of don't appreciate fully is that deals are very, very complex. And I think there's lots of issues from human resources, regulation, logistics, funding, different legal environments that come into play.
There is, however, still growing interest, mainly driven by the high economic activity that has been experienced on the continent in recent years. According to the Thomson Reuters, out of the 236 African mergers and acquisitions that they have been tracking between September 2011 and March 2012, the energy, mining and utility sectors registered the largest activity and are expected to be the main catalyst of takeovers going forward. For companies to be successful when concluding these transactions, they also need to have an intimate understanding of the environment they will be operating in.
Global clients moving into new territories, moving into Africa, which we can talk about with much more authority, need to understand the real opportunities, need to understand how people go about their business on a day-to-day basis. If you're not on the ground or not prepared to get on the ground and have good local input, you increase your risk of failure.
African governments have embarked on reforms to promote business-friendly environments on the continent and attract investors. One such example is in the case of Ethiopia, where the government privatized strategic economic sectors. The merger and acquisition market, which was at one point non-existent, has experienced the takeovers of previously state-owned breweries, companies by international firms such as Heineken, Diageo and the Duet Group. The total value of the deals reached as much as $500 million. The African market is poised to grow in the coming years. In addition to its natural resource potential, the continent is also offering investors a $1 billion consumer market. Dumisha Machanyele, Johannesburg.
Joining me in studio this week to take a closer look at mergers and acquisition activity on the continent is Peter Steyn. He's director at Worksmans and chairman of Lex Africa. And joining our conversation from our Nairobi bureau as well is Ernest Cheriot, who's the director of transactions and restructuring at KPMG Kenya. Welcome to you both, gentlemen. Thanks so much for joining me. Let's perhaps start off right here in Johannesburg, Peter, with your sense of the kind of landscape we're looking at when it comes to one that's enticing M&A activity on the continent. That insert very emphatically highlighting that what investors are chasing is the growth potential specifically.
Absolutely, that's exactly why they're coming to Africa. I mean, as the insert also mentioned, M&A activity has been quite low in Africa compared to the world by world standards. But I think you're going to see more of that because merger activity actually flows from growth. Firms want to grow, they merge to get larger market share. So I think you need to distinguish between investment activity and merger and acquisition, because investors often go into African countries, form a subsidiary, do a joint venture. The private equity deals and the venture capital investments, I think, are extremely significant. M&A activity, of course, is the mergers between existing firms in a country or cross-border. So I think it's certainly something which I think we're going to see more of in the future.
Ernest, what we've seen is the crisis of the developed world at this stage, getting people to focus on other parts of the world like Africa. How do we use this to our advantage? Because still the size of the African M&A market stands at no more than 3% of the global M&A market. So it seems like we're not leveraging off the position we're in enough at this stage.
I think the biggest item here is the information being relayed to the countries, like for investors who are outside the country, like America and in Europe. There is generally a lack of information about the continent And I think the onus is on us here in Africa to disseminate that information to our colleagues outside the country and inform them of the numerous opportunities that exist in Kenya and the whole of Africa.
What opportunity exactly are we looking at here? What do we need to be a little bit more informative about?
Well, I think traditionally Africa has always been resource focused, mining, resources. I think the great opportunity is the growth of the African middle class, of consumers. So I think consumer businesses are becoming more and more involved in Africa. I mean, from a South African perspective, you have the ShopRite, the retailers making great inroads into African countries. You have hotel groups, business, other services-orientated companies. Financial services, I think, is booming. And I think one of the great innovations that have come out of Africa is the clever use of mobile technology in Kenya to deal with things like money transfers. I think Africa's got a huge edge in a sense that we can leverage off existing technology and find innovative solutions to our growth and development problems.
We've also got to take a closer look at these industries like telecoms, the financial space, the consumer space specifically, Ernest, because these are traditionally industries with low penetration rates. Therein, highlighting the kind of growth potential the companies could look forward to.
Absolutely. I think you're absolutely right. When you look at the telecom industry, for example, it's not just the large telecom companies that investors should be looking at. They should be also looking at the new technologies and innovations that are emanating out of Africa. For example, the M-Pesa payment system in Kenya. There are numerous investors and new ideas that are coming up in the market that potential investors should be really looking into. And as been mentioned, consumer goods and the food industry, supermarkets, mining, and energy are also very, very sectors that are booming and that investors should take a keen look at.
Of course, we've got volume, Ernest. One thing to consider, what are we looking at when it comes to value? What are you making of the price tags at which deals are currently getting struck?
I guess for the price tag, obviously any M&A activity, what advisors like us would want to do is to add share value to the investors who are coming in. I think the game is all about making money to the investors. And we guide potential investors as to what in the value chain can be added to these companies. In terms of growth, we look at synergies that can be achieved by buying into some of these companies and putting together companies into one block. You can buy into, like, for example, a financial institution in Kenya, Uganda, Rwanda, and you have that regional footprint. Buying into these companies and merging them together gives you better economies of scale, better reach in the regional market, hence increased share value for the shareholders and the investors.
When it comes to that investor base that's filtering through the African borders, they're primarily out of the emerging markets. And that's an interesting trend in itself, that we're seeing more activity or more investors coming through from emerging markets as opposed to the developed world. What sense are you making of that trend?
I think the developed world are still active in Africa. But I think that obviously the main game changer in the African scenario has been Chinese involvement. But I think one underestimates the involvement of countries like India and Brazil. Brazil particularly has focused on the Portuguese-speaking countries, Angola, Mozambique, but has become a major player in those countries. China and India, I think, are major players.
If you're looking at some of the reasoning that I came across, it says that investors from emerging markets are less worried by the perceived risks in Africa. Is there more of a distinction being made between a perceived risk and actual risk?
I think there's always risk in business, but I think sometimes there's a familiarity possibly. I mean, Africa is an emerging market. If you're a businessman in an emerging market, there may be issues that are familiar to you. And that makes it easier, I think, to mitigate the risk. I think there's risk in America, there's risk in Europe, there's risk in any business dealing. But I think there's a familiarity which helps investors from emerging markets to more easily minimize and mitigate and take the risks in Africa. And take advantage of the opportunities, because I mean, people talk of risks and challenges, but they're undoubted opportunities.
Ernest, from the conversations that you have with clients, what sense do you get in terms of the perceptions they have around Africa, the kind of risk they're taking on coming and doing business on the continent?
I guess it's also, I would say it's familiarity problem, and again, many investors that I speak with in, for example, America, sometimes would like to get into investments that are fairly large, so they usually would shy away from the 10 to 20 to $50 million kinds of investments. So sometimes also it's a matter of the investments being worth their while for them to make the trip here and invest time here and look at the businesses. So that's one problem that I've seen. The other problem, obviously, is the information that they're getting from the continent when they start looking at companies. Sometimes the information, like the historical records of the company that these sophisticated investors require, sometimes are just not there. And if they're there, they still need a lot of polishing up. And when an investor starts off with that kind of footing, they tend to shy away. But again, as I said, I think it's up to us in Africa to keep on walking through the investors through the process and educating them on really the possibilities that exist in Africa. And that kind of education.
We've seen some governments try to put incentive on the table. The insert highlighting the fact that the government of Ethiopia specifically has worked to privatize key sectors of its economy in a bid to increase investments. What do you make of that kind of strategy that's being employed?
I think that's definitely a very important strategy because the governments have a role to play in instilling confidence in investors. For example, here in Kenya, we just had in January the PPP law that was passed. Such kind of laws that the governments are passing in the region will go ahead in enhancing the confidence that foreign investors have. So what's happening in Ethiopia, what's happening in Kenya is really recommendable, and we'll definitely see more investors coming into the continent.
Of course, what would lend to enhancing or increasing confidence, investor confidence in doing business on the continent is addressing the cost imperative as well. Let's take a look at that and whether or not it's being adequately addressed in your books.
I think one of the huge challenges which African governments are aware of but need to significantly address are those things like cross-border intra-African trade. The costs of transporting goods from a Central African country to the ports. I think those things, bureaucratic delays, customs, excise. I mean, there have been some achievements in that one-stop border post between Zambia and Zimbabwe has made a huge difference just on the time of getting goods from ports to markets within Africa and getting goods from within Africa to the ports, to the export markets. I think that's costs are obviously a huge issue.
Peter, just taking a look at this cost environment, do you see the table starting to turn at all where there may be the cost imperative to producing finished product on the continent itself, because there is pressure to shift to lower cost locations, even the Chinese starting to consider it a little bit more aggressively?
I absolutely agree. I mean, one of the major developments I think in recent years, and will become increasingly so, is the impact of increasing labor costs in China. I mean, you've got companies, European and American companies, who are now closing their their Chinese operations and moving back home. And I think Chinese firms are also going to be looking for alternative countries within which to manufacture their goods. Southeast Asia, but I think Africa's got a huge opportunity. And that's a manufacturing opportunity, which would be a different type of investment to the traditional African investments in mining and resources.
Yeah. How concerned, Ernest, are investors when coming into the continent about cost, but also about the infrastructural support that they will have at hand to be supportive of business growth moving forward?
Yes, cost is definitely a big issue that we've had investors talk about. And if we look at Kenya and East Africa, for example, like in Kenya, the new government that has just come in 2 weeks ago, they've gone out of their way to say that they are going to reduce the cost of doing business in Kenya. And this is achieved by definitely having the right infrastructure in place to support businesses, having the right regulations to support businesses, and also areas like telecommunication and the IT sector, which reduces costs. Those need to be in place, and governments have a big role in ensuring that those are in place for the sake of the business people who are coming into the continent, for them to go about their business with some ease.
Heading into a short break right now, we're going to be saying goodbye to Ernest Cheriot, who's the Director of Transactions and Restructuring at KPMG Kenya at this point. But when we come back, we take a closer look at the regulatory environment and whether or not that is supportive of more M&A activity on the continent. We have more on Invest Africa straight after this, so don't go away. Welcome back. You're watching Invest Africa, where we're taking a look at mergers and acquisitions on the continent, the kind of activity we're seeing in that space right now. And still with me on the desk is Peter Steyn. He's Director at Worksmans and Chairman of Lex Africa. And joining our conversation now from our Zambia Bureau as well is Luyamba Mpamba, who's Acting Director of Mergers and Monopolies in the Department of Competition and Consumer Protection in Zambia. Welcome to Luyamba. Before we take the conversation to her, I mean, we can talk about growth potential that the African continent boasts, the cost imperative and needing to enhance that, the infrastructural support that needs to be given to business to entice investment this way. But it means very little, Peter, if we don't have a supportive regulatory environment as well. In South Africa, we've had a couple of deals, Kansai Paint vying for free world coatings, even more prominent, the Walmart, Massmart transaction, and regulation around competition, specifically seeming to be a pretty big stumbling block. Even the Metropolitan and Momentum tie-up have seen competition rules or conditions being attached to it. What's your sense in terms of the kind of message we're sending out there to potential investors?
I think the key thing with regulation is where to draw the line, where to draw the borders. And I think the second key point is that it must be clear and certain. Investors and businessmen, both local and foreign, want certainty. They want to understand what the rules are. Now, you mentioned those South African cases. I'd say the vast majority of mergers which are notified to the South African Competition Commission are approved unconditionally. Mm-hmm. I mean, there are contentious cases. And, you know, in those cases where the minister exercises rights under the Act or where parties object to the merger, I think the competition process in South Africa is there to give a full ventilation of those issues. If people are aggrieved or have objections to a merger, that they're entitled to come and make their case before an impartial tribunal, and with appeal rights to the appeal court.
At this point, I think it's very important to highlight this. It's not just a South African phenomenon that we're looking at. We've seen it in Canada, we've seen it in Namibia as well. And it seems like this comes about by way of a new economic era as a whole. Countries are simply becoming a lot more protectionist than they've been at the past. So that's important to keep in mind when we're having a conversation like this.
Yes, absolutely. I mean, competition law is a worldwide phenomenon. In fact, it's grown exponentially in the last few years. Many African countries are adopting competition laws, and I think the most significant development this year has been the COMESA Competition Commission coming into operation. COMESA being a regional body of 19 African countries, from Libya and Egypt in the north all the way down to Zambia, Zimbabwe, Malawi, including Swaziland, but excluding Mozambique and Tanzania, which is an interesting.
Luyamba, of course, on the one hand, you have a business looking down this avenue to better market access and increase their competitiveness on a global scale as well. And then you've got governments looking to protect their own citizenry, ensuring that the tie-ups do not, promote anti-competitive behavior. It's a pretty tough balancing act to play. What's your assessment of how right you're getting things over in Zambia?
I think it's been working well. We've been trying to strengthen our competition and regulatory rules and regulations as we've been witnessing a number of mergers and acquisitions coming into Zambia. We have to ensure that the mergers that come into Zambia benefit both the consumers, the people of Zambia and the economy, as well as the competitors that they find in the economy. So we've been working at strengthening the regulatory environment in the country. And as Peter mentioned earlier, the coming in of COMESA, I think that will need a much stronger competition bodies in all the member states if we're going to encourage mergers and acquisitions in this market. COMESA market is still relatively a small market, so I think having a very strong regulatory authority in each member state is what we need right now.
Peter, highlighting that it's all about the clarity of the regulation that's put on the table as well. That's what investors want. That's what secures peace of mind to an extent. What kind of shifts are we seeing in the regulatory regime when it comes to, M&A activity and regulating competition within various industries over in Zambia?
I think we've been witnessing a number of, or an increment rather, in mergers and acquisition in the mining sector, as well as the construction sector. So at this point, where we're looking at transnational mergers, I think it's very important for the merging parties to understand the regulations, the commercial regulations, and what needs to be done at the time they're merging. Because I think what we've been witnessing as a commission is this lack of clarity in the regulations and what body you go to, whether you come to Zambia, you notify the Competition and Consumer Protection Commission in Zambia, as well as COMESA. So I think that is not really clear to the merging parties out there. So we need to work together as member states in making this very clear for merging parties.
Practically speaking, Peter, how defined a line can you be looking at, can you establish, especially where you've got, in the case of South Africa, your labour unions getting pretty vocal and a lot louder now than they perhaps have been in the past?
I think the line of regulation is obviously drawn by statute first and foremost. And I think, using the COMESA example, I think one of the challenges, the COMESA Commission is intended to be a regional body, a one-stop shop for mergers and acquisitions in the COMESA region, which is a great concept. But I think the tension is between national regulators and COMESA. Some national regulators, the Kenyan regulators, said that you still have to file in Kenya, even though you file in COMESA, which means double filing delays costs. I think those sort of issues need to be dealt with. As far as the line of regulation is concerned, again, clear legislation. Using COMESA again as an example, and I filed the first merger filing with COMESA Commission last month. One of the issues is that the wording is not clear. Strictly speaking, if the target firm, the firm that's being bought, is not in COMESA, in a COMESA country, due to the wording that is unclear in the regulations, you would still, strictly speaking, be obliged to get their approval if the buyer operates in 2 or more COMESA countries, which makes no sense at all.
So there's still a lot of work to be done in terms of fine-tuning the kind of policy we're putting out there in order to entice investors.
Yeah, I think the key thing is, it's a work in progress. A new law comes into focus. There'll always be interpretational issues. And I must say I've been heartened by the COMESA Commission's practical approach to some of these issues. And I'm hoping that we get guidelines from them which will help clarify things. Because as I said earlier, it's absolutely critical that any sort of regulation, not just competition, any sort of regulation is clear and the investors understand it. And of course that the fees are not too high, because the COMESA fees can go up to $500,000, and that in itself could be a deal killer on the smaller deals.
Absolutely. Big disinvestment we could well see on the back of those costs that are associated with dealing with companies on the continent. Luyamba, let's take a look at Zambia specifically, because you mentioned that we're getting interest specifically directed towards the mining sector, towards the construction space as well. What kind of incentive is government putting on the table to attract investment its way?
Well, there are a number of incentives that the government is putting across to attract investment into the country. So maybe right now I couldn't stipulate each and every bit of the incentives that the government is putting up, but I think these have been key sectors of the economy that we want to see develop in the country. So the more mergers and acquisitions that occur, maybe in the construction sector, in the agriculture sector, that is a welcome move for the government, because, they have picked up priority sectors that they would want to develop in the next few years.
What's your outlook as far as M&A activity in the country is concerned moving forward?
Moving forward, I think the outlook would have to be an increment in the number of mergers and acquisitions that we're going to receive in the next few years. I think our economy has been growing relatively, and I think that has also been seen from the number of mergers and acquisitions that we have received as a commission. So that's likely to increase.
Well, let's leave it there. Thanks so much, Luyamba, for having joined us this afternoon, and to you, Peter, as well. That's where we leave it for this edition of Invest Africa. Big thanks to my guests, Peter Steyn and Ernst Cheriot, of course, who joined us in the first half from Kenya, Luyamba Mpamba as well. Until next week, from me, Alicia Second, it's goodbye.